Hey everyone, welcome back to the show. If you're new here, welcome. Grab your coffee, tea, or whatever gets you through the day and settle in. Today we're talking about one of my favorite topics, dividend investing. And look, I know what you're thinking. Dividends? That sounds about as exciting as watching paint dry. But stick with me here because we're talking about a strategy that literally pays you cash just for owning stocks. It's like having a vending machine that you only have to stock once and it keeps spitting out money. Okay, that's a terrible analogy, but you get the idea. So, full transparency. I'm not one of those finance bros who's going to tell you I retired at 25 with dividend income while sipping mojitos on a beach. I'm a regular person who made plenty of mistakes with money, including that one time I thought I could day trade tech stocks in 2020. Spoiler alert, I could not. I learned expensive lessons about chasing hype and trying to time the market. But dividend investing? That's been a completely different story. It's slower, it's boring in the best possible way, and it actually works. It's like the difference between trying to get rich quick with lottery tickets versus planting an apple tree in your backyard. One gives you instant disappointment, the other gives you apples for decades. All right, let's start with the basics. What actually is a dividend? Simply put, a dividend is a payment that a company makes to its shareholders out of its profits. You own a piece of the company through your shares, and the company says, hey, we made money this quarter, here's your cut. It's important to understand that not all companies pay dividends. A lot of younger, growth-focused companies, think like many tech startups, they reinvest all their profits back into growing the business. And that's fine. There's nothing wrong with that strategy. But mature, stable companies, your Johnson & Johnsons, your Coca-Colas, your Procter Gambles, they've been around forever. They print money, and they share some of that money with shareholders regularly. Most dividends are paid quarterly, so 4 times a year. Some companies pay monthly, which is pretty sweet if you're trying to build actual income you can use. And the amount you get is based on how many shares you own. Here's a simple example. Let's say you own 100 shares of a company, and that company pays a dividend of 50 cents per share every quarter. That means every 3 months, you get $50 deposited into your brokerage account. That's $200 a year. Now, $200 doesn't sound life-changing, right? You're not quitting your job over that. But here's where it gets interesting. And this is where my own aha moment happened about 5 years ago. I was sitting there looking at my regular savings account, which was paying me basically nothing in interest. We're talking maybe 0.1% at the time, which is insulting. I had about $10,000 just sitting there, doing nothing. And I thought, what if I put this into dividend-paying stocks averaging 4% yield? 4% of $10,000 is $400 a year. That's not retire early money, but that's a nice dinner out every month, or my phone bill paid, or part of my car insurance. And unlike that savings account, these dividends tend to grow over time. This is the part that really sold me on dividend investing. Dividend growth. Many established companies increase their dividends every single year. There are companies out there, they call them dividend aristocrats, that have increased their dividends for 25 consecutive years or more. Dividend kings have done it for 50 plus years. These are companies that survived recessions, market crashes, everything, and they kept raising their dividends. Think about that. If you buy a stock today that pays you a 3% dividend yield, and that company raises their dividend by 7% every year, in 10 years, you're earning a 5.9% yield on your original investment. In 20 years, almost 10%. Your initial investment is now generating double-digit returns in passive income every year. This is what people mean when they say, plant the tree today so you can sit in its shade tomorrow. Except in this case, the tree also occasionally drops $20 bills. Let me tell you about my first dividend payment, because it honestly kind of blew my mind. I'd been reading about dividend investing, and I decided to buy shares in a boring company that makes consumer products. We're talking soap, diapers, that kind of thing. Nothing sexy. I bought about $1,500 worth of shares. 3 months later, I'm checking my account, probably too often, which is a bad habit, and there's just this random deposit of $13.47. And I'm like, what is this? Did someone send me money by accident? Then I realized, oh, that's my dividend payment. I literally did nothing except own the stock, and they paid me. I didn't have to work overtime, didn't have to sell anything, didn't have to click any buttons. Just boom, money appeared. $13.47 is not going to change anyone's life, but the concept, that kind of blew my mind because I realized this payment would happen again in 3 months and again after that. And if the company kept doing well, it would be a little more each year. That feeling, that's what got me hooked on dividend investing. Okay, so how do you actually do this? How do you build a dividend portfolio that creates meaningful passive income? First, let's talk diversification. Please, please, please don't put all your money into one company just because it has a high dividend yield. I don't care if it's paying 8%. If that company goes under, you've lost your principal and your income stream. I aim for at least 15 to 20 different companies across different sectors. I want some healthcare stocks, some consumer staples, some financials, some utilities, some industrials. That way, if one sector struggles, my entire income stream doesn't disappear. Second, focus on dividend sustainability, not just yield. This is crucial. If you see a company paying a 10% dividend yield when most similar companies pay 3 to 4%, that's a red flag, not an opportunity. High yields can mean that companies in trouble and the market knows it. The dividend could get cut and that stock price could crater.
I look for companies with a history of paying and growing dividends, at least 10 years, a payout ratio under 75%, meaning they're paying out less than 75% of earnings as dividends. They have room to maintain and grow it. Strong, stable businesses that people need in good times and bad times. Reasonable debt levels. Now, here's my favorite strategy. Dividend reinvestment plan. Instead of taking those dividend payments as cash, you automatically reinvest them to buy more shares of the stock. Most brokerages let you do this for free, no commissions, and you can even buy fractional shares. Why is this powerful? Compound growth, baby. Let's say you invest $10,000 in a dividend stock yielding 4%, and that dividend grows by 6% per year. If you just take the cash dividends, after 20 years, you'll have collected about $14,600 in dividends. Plus, you still have your $10,000 in stock, probably worth more. But if you use dividend reinvestment plan those dividends, reinvesting them to buy more shares, which then pay more dividends, which buy more shares, after 20 years, your investment could be worth over $35,000. That's the difference between linear growth and exponential growth. I made dividend reinvestment plan all my dividends for the first 5 years. Every payment bought more shares. I wasn't making much money at the time, so I couldn't afford to invest new cash regularly, but my dividends were investing for me. It's like having a little robot that works for you 24/7. Now, there comes a point where you might want to switch from reinvesting to actually taking the dividend income as cash, the whole passive income part. I started doing this partially last year. I'm not financially independent or anything, but I now get about $350 a month in dividend payments that I just let hit my checking account. I use it for groceries usually. There's something psychologically powerful about this. It's like having a part-time job that requires 0 hours of work. And because I built the portfolio with quality companies, that $350 should be $375 next year, $400 the year after, and so on. My goal is to get to $2,000 a month in dividend income within 10 years. That would cover my rent, which would be absolutely life-changing. Even if I still needed to work, knowing my housing is covered by passive income, that's the kind of financial security that lets you sleep well at night. All right, let me share some mistakes I made and that I see other people make so you can avoid them. Mistake number 1, chasing yield. I already mentioned this, but it bears repeating. I once bought a stock paying an 8% dividend because I got greedy. More money, faster, I thought. 6 months later, they cut the dividend in half and the stock dropped 30%. I learned that lesson the expensive way. Mistake number 2, forgetting about taxes. Dividends are taxable income, folks. Depending on whether they're qualified or non-qualified dividends, you could pay anywhere from 0% to your regular income tax rate. Do your dividend investing in a Roth IRA if you can. The dividends grow tax-free. I wish someone had told me this earlier. Mistake number 3, ignoring the stock price. Just because a company pays dividends doesn't mean the stock price can't fall. You need to care about the quality and valuation of the business itself. A great dividend from a terrible business is still a bad investment. Mistake number 4, being impatient. This is a long-term strategy, like really long-term. If you're expecting to retire next year on dividends, unless you're investing hundreds of thousands of dollars, it's not happening. I think of dividend investing as a 10, 20, 30-year plan. It's boring, it's slow, and that's exactly why it works. So if you're listening to this and thinking, okay, I want to try this, here's what I do if I were starting over today. Step 1, open a brokerage account if you don't have one. You can mention Fidelity, Schwab, or a major low-cost brokerage. Most of them are good nowadays with 0 commissions. Step 2, start with an amount you're comfortable with. Maybe that's $500, maybe that's $5,000. Whatever you can invest that you won't need for at least 5 years. Step 3, consider starting with a dividend-focused ETF or index fund. Something like VYM or SCHD. These are baskets of dividend-paying stocks, so you get instant diversification. Learn from those holdings. See what kind of companies pay good dividends. Step 4, as you learn more and get comfortable, you can branch into individual stocks. Research companies, read their earnings reports, understand what they do. Step 5, set up automatic dividend reinvestment plan on everything and then honestly try to forget about it for a while. Check in quarterly, but don't obsess daily. Look, dividend investing isn't glamorous. Nobody's making YouTube videos titled, I bought Procter Gamble stock and you won't believe what happened next. Because what happened is nothing dramatic. The stock went up a little, down a little, and paid a steady dividend. Boring. But boring has built more wealth than exciting ever has. I think about my grandparents who worked regular jobs their whole lives but retired comfortably because they bought good stocks and held them for decades. They didn't trade crypto or flip houses or start 17 side hustles. They just consistently invested in quality companies and let time do the heavy lifting. Dividend investing is my attempt to follow that same path. It won't make me rich overnight, but in 15 to 20 years, I genuinely believe I could have enough passive income to make work optional. And that's the goal, right? Not necessarily to stop working, but to have the choice. All right, that's what I've got for you today. Remember, I'm not a financial advisor. I'm just someone sharing what's worked for me. Do your own research, understand your own risk tolerance, and invest accordingly. If you found this helpful, share it with someone who's looking for ways to build passive income. And hey, if you're already dividend investing, I'd love to hear about it. What companies are you excited about? What's your strategy? Until next time, happy investing, and remember, the best time to plant a tree was 20 years ago. The second best time is today. Take care, everyone.